Thank you for joining us today. Welcome, everyone. Financial Plus Credit Union is excited to host this webinar on navigating the process of home buying. We understand the process can be overwhelming if you don't know where to begin. A little bit about us is possibilities begin here. For more than 70 years, we have been passionate about helping our members and communities reach their financial goals and achieve their dream of home ownership. I am Marcy Dienauer, Mortgage Sales Manager, and I will be your moderator today. A few administrative items. We will be taking questions throughout the webinar, so please feel free to type them in the chat box. If we don't get all of your questions answered, we'll follow up with a question and answer sheet to share with you within a few days. Also, we will provide our contact info at the end of the webinar, so please feel free to contact us anytime for more information. Additionally, this webinar will be recorded, so please keep your microphone on mute. Thank you. At this time, I would like to introduce our presenters, Rosemary Boan and Derek Lewis. Shall we begin?
All right, excellent. Well, hey, thank you so much, Marcy. My name is Derek Lewis. I'm one of the mortgage loan officers here with Financial Plus Credit Union. I've been with the credit union for nearly 10 years now, and in the mortgage department for about the last 4 years. I love the process of helping people come alongside them and navigate one of the biggest transactions of their life, probably the biggest, and that's buying a home. It can seem like a daunting experience, and so I love being able to break down the steps, make it simple, make sure that everyone understands exactly what they're doing, whether it's their first time through it, or maybe they're looking to buy that second home, their dream home, rental home, whatever that might be. Outside of the credit union and outside of doing mortgages, I've got a wonderful family I love spending time with. I've got 2 beautiful daughters, and they keep me plenty busy. I'm one of those weird lawn nuts who enjoys mowing the lawn and also playing golf whenever I get the time. So I'm definitely looking forward to this and hoping that we can provide you guys with lots of value.
Hi, everyone. Thanks for joining us this evening. My name is Rose, and I'm also a mortgage loan officer here at Financial Plus. I have been with Financial Plus for about 16 years now, and about 8 years ago, I finally found my home here in the mortgage department. I really love having the opportunity to help people achieve their dream of home ownership, and then also helping people who already own a home explore their options for refinance or home equity loans. Being able to help people, educate them on the process and guide them through the steps of what is usually a pretty intimidating process is what I really enjoy. When I'm not here in the office, I also enjoy spending some time with my family, but during our summer months, you'll definitely find me on a lake somewhere. So let's talk about what you guys are going to learn today. We're happy to have you all here, and we're looking forward to helping you understand the mortgage process just a little bit better. What you can expect to learn is the process of purchasing a home from the pre-approval stage to the closing stage, our different mortgage options for new homeowners and current homeowners, as well as our different refinance and home equity products that we offer at Financial Plus. Throughout our presentation, we'll also be stopping to answer some of the most frequently asked questions that we get asked in our line of work. So let's get started.
All right, excellent. So before we get too into the actual presentation and talk about the ins and outs of the mortgage process, what to expect and how to navigate that, we just wanted to spend a second to talk about reasons that you would want to become a homeowner. Now, we believe that everyone should have the chance to fulfill their dream in owning a home. And if you're on this Zoom call, then we're betting that you believe that as well, that you're wanting to either own a home or maximize the equity or value in the one that you currently have. Now, the rest of America feels the same way. So I pulled up a stat here. According to Bankrate's 2023 Financial Security Survey, 74% of U.S. adults mentioned homeownership as part of the American dream. Now, this outpaced being able to retire, having a successful career, owning a car or truck, having children, and even getting a college degree. So it's clear that home ownership is at the top of everyone's mind. And so we understand how important that is. So we want to come alongside you and help make that dream come true. There's many benefits when it comes to owning a home. We're going to share just a few of those that that we believe are so powerful. And hopefully it gives you guys an idea of what might be waiting for you as you become a homeowner. So you're going to have probably your own benefits, maybe your own reasons for wanting to buy a house. Maybe you're wanting to get out of that basement that you're living in. You're wanting to move to a new neighborhood, expand the current size of the home that you have. Maybe you've got a growing family. And so all these are amazing reasons to want to become a homeowner. Some of the additional reasons that we have listed here are wealth building. That's one of the #1 reasons people don't often think about when it comes to buying a house. Your home is more than just a roof over your head, but it also gives you the potential to build wealth even at a generational level. I read a study that said that homeowners compared to renters have about 40% more in their net worth. And so it's a huge factor when it comes to generating wealth in owning a home. Now, owning a home also gives you the ability to borrow against the equity in your home. And we're going to talk a little bit more about what that looks like and how that works towards the end of this presentation. Some other things are it gives you protection against inflation. You're able to buy a home at a set price, and that price is not going to increase on you as the years go on. If rates change or whatnot, you are locked in and you're able to keep maybe that low payment that you started with. Owning a home comes with tax benefits. We recommend checking with your tax professional on that. It also gives you the benefit of credit building. All of your payments that you make on a mortgage are reported to the credit bureau. And as long as you're making payments on time, you're able to build positive credit. Of course, owning a home gives you the freedom to customize, not just where your home is located, but what you do with that home when you own it. If you want to take down a wall, put on an addition, or change, whatever it may be about the home, you have the ability to customize. And finally, it gives you a sense of community. When you buy a home, you're not just buying your individual house, but you're planting yourself in a neighborhood or on a piece of land or wherever it is that you're looking to be. But you're surrounded by neighbors and community, and it helps you feel connected to those around you. So we're going to talk now about key factors for qualifying for a mortgage. Some of the key factors are, #1 is going to be your credit score. This is probably self-explanatory and one of the biggest questions that we get. But when it comes to buying a home, your credit score is going to be one of the most important factors. Making sure that you've got strong credit, good payment history. We're going to pull your credit from all 3 credit bureaus, Experian, TransUnion, and Equifax. And we're going to take a look at your credit report to see if there's any late pays, things that we should be concerned about, and use that to determine, interest rates and potential closing costs, which we'll cover here in just a little bit. Another big part of qualifying for a mortgage is ensuring that you have enough income. We want to make sure that you've got enough money coming in to take care of those payments going out. And so we're going to want to make sure that you've got steady employment history and that you can back that up with proof of income, which would be pay stubs, W-2s, sometimes tax returns, and various other items. We also look at your debt to income ratio. That's a factor that we use that compares the amount of debt that you have or monthly obligations to the amount of income on a monthly basis that you have coming in. And we look at the amount of your gross monthly income, so before taxes are taken out. We want to make sure that we're keeping you at a healthy spot, not just to protect the credit union as the lender, but we want to make sure that we're putting you in the best place possible so that you can make those payments and not have any worry about the future. And then finally, we want to make sure that you've got enough funds. That's going to be assets and reserves. We're going to use bank statements, even maybe 401k or investment accounts to see how much money you have and how much you're able to contribute towards the purchase. All of those factors are going to come into play and will be reviewed when it comes to making a decision on qualifying you for your mortgage. So we're going to move to the next slide. Rose has our first frequently asked question.
All right, yes, our first question, and that question is going to be, what is the difference between a pre-qualification and a pre-approval? The biggest difference is that with a pre-qualification, your information is not usually verified. Whereas with our pre-approvals, a loan officer is going to request proof of income, assets, and they're going to pull your credit. They just want to make sure that you do fully qualify for the loan. Realtors and sellers both prefer that you have a pre-approval. Pre-approval is going to let them know that you've already been approved for financing and that they're not going to be wasting their time showing you homes or letting you into their homes. So now that we know the difference between a pre-approval and a pre-qualification, let's go over how you can get a pre-approved here at Financial Plus. So step 1 would be to submit your application, which we currently offer 3 different options for applying. You can apply right on our website, in any of our 12 branches, or over the phone at any time. And then step 2 would be submitting your documentation to your loan officer. This is when we're going to ask for your pay stubs, your W-2s, and bank statements. There's usually going to be some more info needed, but those are just the basics. During step 3 is when your loan officer pulls credit and gives it a good look over to see if you're going to qualify for the loan. And then finally, step 4 is when you receive your pre-approval letter. The pre-approval letter is going to be good for 90 days after we pull your credit. And that's about it. 4 easy steps to get pre-approved.
All right, excellent. So next question here that we hear all the time is, do you need to have an excellent credit score to get approved for a mortgage? Now, the answer to this varies. So you don't have to have an 800 or 850. You don't have to have the top of the line credit score in order to get approved, though it certainly can help. Credit scores are going to range from 300, 350 up to 850. Now, while a higher credit score will increase the likelihood of approval for a mortgage and better terms, but it doesn't mean that you have to have a top credit score in order to qualify. Different loan programs are going to have different requirements around what they allow for credit score. As you can see on the slide here, 2 of the most popular loan options, conventional FHA, have different options for that. Conventional is going to be a little bit more strict. They require a minimum of at least 620 of a credit score to qualify. FHA will be a minimum of 580. Now, these are very set in stone. They're very black and white. If you are a 619, we're not able to bump you up to the conventional, or if you're a 579 up to an FHA, you're going to have to make sure that your credit score is at least that point or higher to have a chance of qualifying. And keep in mind, other factors do come into play. Even if you have a credit score that's high enough to qualify, depending on debt to income ratio, pay history, all of these things, it still may not mean that you'll have 100% chance of approval for that loan. So your lender's gonna, when you apply for credit, we're gonna look at your credit history. Obviously, the bigger the purchase on these mortgages, the greater scrutiny on your credit and the history of your ability to repay. Your credit score is a number that represents your credit worthiness, and we've kind of talked about that. The higher your score, the better. And it's based on a few factors. Largest one is payment history. That's about 35%. The amount of total debt owed is about 30%. And then on down from there is the length of time that you've had it open, your credit mix, and then the amount of inquiries that you've had. Your payment history, as I mentioned, is the most influential part of your credit score. So if you're in this webinar and you're looking to try to get approved for a mortgage, the biggest thing that you can do currently is continue to make payments that are current on all of your current obligations. That will give you the greatest chance of getting approved. All right, that takes us on to question number 3. This is probably the one that I get the most, and this is probably the biggest myth when it comes to buying a house, and that is, do you need a down payment of 20% to purchase a home? Now, you guys can think about this. Some of you out there might have heard this and might have thought this, and I've worked with many people who thought they had to save up, wait till they had 20% before they could even begin the process for buying a house. The good news is that it is not required that you have 20% put down. The minimum down payment, just like credit score, is going to depend on the type of loan program that you choose. The larger your down payment, obviously the smaller your monthly payment will be. Now, conventional mortgages typically are going to be around 3% for a first-time home buyer or 5% for repeat buyers. FHA will allow as little as 3.5% down. And there are loans like a rural development where you may be able to get away with putting as little as 0% down when it comes to that. The reason that 20% is such a big number that we hear is because that's the amount that's required to put down to avoid having private mortgage insurance or PMI on your loan. We're not going to get into a ton of detail on this slide on private mortgage insurance, but we will cover that later. So that is really good news. I mean, when you're talking about, you know, a $200,000 loan, thinking that you need to put 20% down, it's a huge burden. But knowing that you might be able to qualify with as little as 3.5%, 3% down can make all the difference in the world there.
All right. Today, I just wanted to go over some of the products we offer currently here at Financial Plus. Speaking with your loan officer, they're going to be the ones to help you determine which loan option fits you best. But let's just go over the basics of what we offer. So firstly, our conventional loan is our most popular product, and conventional just means that it's not insured by any government program. Conventional mortgages are usually with several different term options. with most people choosing between a 15 and a 30-year term. They also have a fixed rate, which means the rate will not change for the life of the loan. Another very popular loan type we offer is the FHA loans. FHAs are insured by the Federal Housing Administration, and it's a program designed for lower income borrowers and those who might be struggling with credit issues. Next, we have a MSHDA loan, and MSHDA stands for Michigan State Housing Development Authority, and it's a loan for first-time home buyers throughout the state of Michigan and repeat home buyers in certain areas of Michigan. MSHDA is a program for lower income families as well, so income limits do apply, but MSHDA does offer a really great down payment assistance program for those who qualify. And then we have a rural development loan, and this loan is offered through the U.S. Department of Agriculture. This loan is designed for low to very low income families, and it's designed to help them purchase homes in rural areas. With this loan, income limits are also going to apply as well. And then we have a jumbo loan, and it's called a jumbo loan because that's what it is. It's big, it's jumbo. Jumbo loans are any loan that exceeds the current maximum purchase price for a conventional loan. So in 2024, that amount is $766,550. If you're financing anything over that amount, you would be in what we call a jumbo loan. And then we also offer investment loans. An investment loan is something you would use to purchase a rental property or a house that you're considering flipping. It's to purchase any home you don't plan to live in, but you'd like to make some income off of it. And then finally, our vacant land loans. This loan is to purchase that dream piece of property that you're going to build your home on one day.
All right, very good. So we've talked about, or Rose has talked about a couple different, or the variety of the different loan options that we have. We're going to take a look right here just to quickly break down a comparison between two of the most popular, which is going to be conventional and FHA. Now, we've kind of already hit on a few of these things, so this will sound familiar. But as a reminder, conventional has a minimum credit score requirement of at least 620. FHA's is 580. Conventional require a minimum down payment of 3% for first-time home buyers or those who haven't owned a home in the last 3 years. And FHA is going to be 3.5% regardless of first-time home buyer status. Max seller concessions are a little bit different here. A seller concession is when you're actually getting money from the seller of the home that you're looking to purchase, and you're able to utilize that towards the closing costs. It's something that you can negotiate when purchasing a home and can be a really good option for those who may not have quite the funds needed to get into that house. Conventional is going to have two different standards here. They'll allow 3% concessions, and that's based off of the sales price if you're putting less than 10% down. And if you're putting greater than 10% down, they will allow up to 6% of the sales price to be given to you by the seller towards the closing cost. FHA, as you can see, is just straight across the board at 6%, regardless of how much you're putting down. So it gives you greater options there if you're putting less down. Private mortgage insurance, we're going to hit this in just a couple slides, but this terminates on a conventional mortgage, typically at 78% loan to value. And on an FHA, generally speaking, it runs for the life of the loan, though if you're putting a large amount down up front, there are options for having it less than that, around 11 years for that. Risk-based pricing. So this is an interesting one, and this can really make a big difference in the type of loan that you might want to look at qualifying for. A conventional loan is going to use, just as it sounds, risk-based analysis to determine your interest rate and your closing costs on that loan. So depending on how much you're putting down, depending on your credit score, even the type of property that you're looking to buy, a stick-built versus a manufactured versus a condo, all those different types of properties will have their own risk assessment attached to them. And if conventional deems them as more risky, it can increase the interest rate and the closing costs. FHA does not have that. So regardless of what your credit score is, whether you just squeezed by at 580 or you have a perfect 850 credit score, you will still get the exact same rate that FHA offers. This can be a really big bonus or benefit for those especially who might have lower credit or not able to put enough down. I've seen where it can make or break the offer or the qualification that a buyer is looking to get when we go from conventional to FHA. because maybe the interest rate or the closing costs were just sky high on conventional. But because FHA does not have the risk-based pricing, it made it a lot more affordable and they were able to get the qualification that they were looking for. So it's really important that you work with a lender who understands these two things and can make sure that they're looking at your best options for you. The amortization term, this is just how long the term of the loan is. As you can see on conventional, those go from 10, 15, 20, or 30 years, where FHA just has 30 or 15. Keep in mind, we do not have any type of prepayment penalty. So you can, do a 30-year loan, but you can still pay it off quicker and not be penalized. And then the rate adjustment, both FHA and conventional loans that we offer are a fixed rate. This means that your interest rate is not going to change on you once you've locked it in up front. For the entire life of the loan, that rate will remain the same unless, of course, you refinance. So next slide here, I've alluded to this a few times. This is PMI, or private mortgage insurance. So what is PMI and how does it work? As you can see here on the slide, PMI is a type of mortgage insurance that's required when you put less than 20% down. Now, this is a small fee that's included in your monthly escrow, and it's collected right with your payment. So it's not something that you're paying separately or you have to remember to make sure that you're paying. It's collected right alongside your standard payment, just added to that standard principal and interest payment along with taxes and insurance. The benefit of private mortgage insurance, some people see that it's a fee and they're, maybe discouraged by that. But what it is doing is it allows you to put less than 20% down, right? If private mortgage insurance was not a thing, you would have to put 20% down every time. So it allows you to put a lower down payment and gives you more buying power. As I mentioned on the previous slides, conventional loans, PMI generally terminates at 78% loan to value. So as you're making payments on your loan, you're driving down the amount that you owe. And then as the home continues to hopefully increase in equity over time, that can free up that loan to value and potentially get that to 78% even quicker than maybe what it originally would have been at. On an FHA loan, it's called mortgage insurance instead of PMI, pretty much the same concept, just a little bit different terminology there. And generally that remains on for the life of the loan, unless you put a large amount down. We've given them more details on that once you start qualifying that route. And in some situations, it can go away around 11 years. So it's a really it is actually a benefit. Private mortgage insurance is a great benefit because it does allow you as a borrower to put less than 20% down for a small fee in order to do that. So definitely something we can dive more into as you begin the mortgage process. So that is part of the mortgage payment breakdown, which Rose is going to explain next.
Yes, thank you. So here on this slide, we wanted to show you what the payment breakdown would look like if you're financing $150,000. So in this particular example, the payment is going to be based on a 30-year mortgage with an interest rate of 6.375%. The full amount for this would be $1,232 a month. And that amount is going to include a principal and interest payment of $935. And then it also includes some smaller payments, $47 a month for private mortgage insurance, $175 a month for property taxes, and $75 a month for homeowners insurance. And again, this is just an example, so those payments for taxes and insurance will vary for each borrower. I also wanted to take a minute and just point out something that you'll see frequently if you're shopping for rates or looking at different loan estimates, and that's something called the APR. So APR stands for annual percentage rate, and it's just a broader measure of the cost of borrowing money. It'll include the interest rate, any mortgage points you pay, and other finance charges. And for that reason, it's usually going to be higher than what you actually pay in interest on the loan. So that brings me to our next frequently asked question, and that is, what is an escrow account? On the previous slide, we went over the breakdown of the monthly payment. It included the $935 for principal and interest, but it also included the smaller payments for taxes and insurance. So those payments are collected each month and held in an escrow account. So your lender can pay your taxes and insurance each year when they come due. The account's established at the closing and just held with the lender. Generally, you're going to pay your property taxes twice a year, once in the summer and then once in the winter. Homeowners insurance is usually paid annually. and PMI is paid monthly. After you close on your mortgage, each year you can expect an escrow analysis. This is something we do to check for any increases or decreases in your tax or insurance amounts. If there are any, your mortgage payment could be adjusted accordingly.
All right, so now that we've kind of covered the process of applying for a mortgage, the pre-approval process, you go through all that, you get us the documents. Now it's time to think about looking for a home. Outside of coming to Rose or I or one of the lenders here to get pre-qualified for a mortgage, the next thing that you're going to want to do that we highly recommend is work with a real estate agent. A real estate agent will help guide you through the entire home buying process, from house hunting up front all the way to closing. As you can see, we've got a list of different things that a realtor will help you with. They will help you find homes for sales that meet your wants and needs. You'll meet with them, let them know exactly what you're looking for, the size of the home, the features that it has, even the neighborhood. And then they'll curate a list of homes that match that and help make sure that they're showing you homes that will be within your budget, within the standards that you're wanting to find, so that you can find that perfect home much quicker. A real estate agent should know the neighborhood and surrounding areas better than you or better than anyone. They're going to be your local pro and be able to help you navigate that process. They'll help set up home tours. And then when it comes time to put in an offer, they'll be able to make sure that you have a competitive offer. They'll negotiate with the seller on your behalf. So if the seller's willing to come down or up in price or all those things, they're going to be able to walk with you the entire process. There is a lot of paperwork involved. There's a lot of things to cover. We do our best to help on the mortgage side, but they do a great job of coming alongside you when it comes to the actual negotiating, signing the purchase agreement, and making sure that you're being treated fairly throughout that process. They're also a great resource to connect with other professionals that you're going to be utilizing throughout the home buying process. It doesn't just stop with the mortgage officer or the realtor. You'll need to get connected to home inspectors, insurance agents, title companies, etc., and they can help navigate that. And then finally, generally, you'll have a agent that works on your behalf known as the buyer's agent. One great thing as well is the cost to use a buyer's agent is extremely low, and some agents have no fees at all. So definitely something that you can ask about when you're checking into that. But the commission for the buyer's agent is generally paid by the seller. So definitely a big perk there to take advantage of the buyer's agent. And then the seller or the one listing the home will typically have an agent working for themselves as well. They're known as the listing agent or the seller's agent. So as far as where to find the right agent, you can ask Rose or I, ask your lender that you're working with. We work with great real estate agents from out the area who might be better connected and know whether you're a first-time buyer or working with a specific loan program. They may have specific skill sets that meet those needs. You, of course, ask for recommendations from family or friends. Maybe you know someone who recently bought a home, had a fantastic experience, and that would be a great person to reach out to. You can meet agents by going to open houses, contacting your local real estate firms for listings and finding out who's listing those. And then, of course, you can do it the old-fashioned way, right? Look them up online, do some Google searches, read the reviews, and make sure that you're working with someone who has your best interest in mind.
Okay, so once you've met with your realtor and you've looked over some homes and you think you found that perfect home, your agent will guide you through the process of writing a formal offer. That offer is going to be called a purchase agreement. A purchase agreement should include the property address, the names of the buyer and the seller, an offer amount, which is how much you're willing to pay for the home, a deposit amount, which is the amount of money you're putting down on the loan for the home, and then an earnest money deposit, which is a deposit made right to the seller to show them you're serious about buying their home. In the purchase agreement, you will also find some information regarding the expiration date of your offer, the expected closing date of the loan, title work stipulations, whether or not you want a home inspection, and any contingencies to your offer. This here is just a small snippet of a purchase agreement. Normally, they're going to be about 8 pages long.
All right, so now you've signed a fully executed purchase agreement. Now you've taken care of doing that. You've got a home under contract. That's one step closer and a big step to getting there at closing day. So what comes next? One of the first things that you're going to want to do once you have a home under contract is contact a home inspector to have a home inspection done. Now, this isn't mandatory on a loan, but we highly, highly recommend it. A home inspector is a qualified professional who's going to take an in-depth and unbiased look at your potential new home. They're going to evaluate the physical condition, structure, construction, and mechanical systems of that home. And they'll help you identify items that might need to be repaired or replaced. They'll be able to give you an idea on the estimates of the cost for replacing those items and even the lifespan of the large systems, equipment, structures, and finishes that are within the house. Of course, you'll also finalize your mortgage application with Rose, myself, or another lender. Once you have a property address, we'll get all the paperwork together for you to begin signing. And then the next step will be, as long as the inspection goes well and you're ready to move forward with the home, we'll be having an appraisal done. This is the process where a real estate appraiser goes out and visits the home. They're going to look inside, outside, take a bunch of pictures. They'll write up a report, and they want to determine the fair market value to ensure that you're not overpaying for that home. You're going to gather a lot of documents. We're going to be bugging you for those up front, and we're going to collect those documents to get your file through loan processing, to evaluate your income and everything, and then eventually to prepare it for the underwriter, who will take an in-depth look at the loan, all of your documents, income, credit, pay history, and make sure that everything checks out. Once we've got everything that we need, the appraisal's done, title work is done, and the underwriter has completed their review, as long as everything is good to go, we'll hear those magical words, clear to close, which means that you are ready to get scheduled for closing and begin signing to buy a home. Now, one thing as well, once you are signing at closing, you'll receive, prior to that, a closing disclosure. We're going to talk about a loan estimate and a little bit more of this in a minute. I'm just going to go over all the final figures so that you're prepared for closing day. So in terms of closing day, you're probably wondering, how much do you need when it comes to buying a house? All right, so we've talked already about down payment. This is the percentage based off of the purchase price of the home that is required to put down for you. For example, as a reminder, 3% might be the minimum required for you if you're a first-time home buyer. That would be, so 3% of a $150,000 purchase means you have to put $4,500 down. However, that's not the end of it. In addition to your down payment, there's also closing costs. These closing costs include things like appraisal, credit report, underwriting and processing fees, title fees, prepaid interest, your first year of home insurance premium, property taxes, the cost to set up and fund your escrow, title insurance fees. There's quite a bit involved in this, and we'll go through a loan estimate where you'll get to kind of see some of those things. But these closing costs come into play, and they're added in addition to the amount that you need of your down payment. So working with the loan officer is going to be really important to ensure that you know exactly what you're required to have so that you're not short when it comes to the closing day. Your total closing costs will vary, and they're dependent on many factors, including your credit score, purchase price, down payment, loan type, and property type. So next slide here is going to be the loan estimate. This is going to be one of the most important documents that you'll receive up front when it comes to the mortgage process, and it gives you an idea, a breakdown of your payment, rates, closing costs, etc. So we'll look really briefly through a loan estimate. This is the first page of the loan estimate. At the very top, it's going to have your name, information, the address of the property that you're looking to buy. It's going to tell you the loan term up top. So you can see in this situation, we're looking at 30 years. The purpose is purchasing a home. Product is fixed rate, just mean that's not going to change, and it's a conventional loan. It'll ask if it's conventional, FHA, another one of those, and you'll see that listed there. Finally, you'll notice the rate lock section. You have the option to lock your interest rate up front, which will keep it from going up or down during the mortgage process. Further down that first page, the first section is going to show you the loan amount. So that's how much you're actually borrowing on, as a loan on the home. It'll have your interest rate and then your monthly principal and interest payment. This amount right here does not include escrow. So if you have your taxes and insurance rolled into that, that will come into play further down that form. As we slide over to the second page here, you're going to see the breakdown of all the closing costs. So this itemizes out everything so that you know exactly what you're getting into when it comes to purchasing a home. You'll see origination fees, services such as the appraisal and credit report, title fees, prepaid interest, all the fees that I mentioned earlier that come into play will be listed here clearly for you to see. Now, as the name implies, this is a loan estimate. So we do our best to get these fees as close as possible up front. Some of them won't change, and we know 100% this is what they will be. And some of them are subject to potentially changing. So it's very important that you are communicating with your loan officer to understand exactly what the fees are and the variance that might come into play. Now, one thing to note is when it comes time for closing, you'll receive a final form called a closing disclosure that looks similar to this. And that's when you'll have all the fees 100% locked in, giving you exactly what you'll need for a closing day. Let's see here. Finally, at the back, it will have a form that's going to show you how much you're paying in finance charges over the first 5 years, breaks down your annual percentage rate, which Rose talked a little bit about earlier, and then gives you your total interest percentage. It shows you how much you paid or will pay over the life of the loan, how much of all your payments are going towards your interest. This is probably one of those pages that you'll enjoy skipping over, but it's very important to review and to check out.
All right, so if you're considering applying for a mortgage or you've already started the process, we put together some do's and don'ts for you. Let's start with the do's. So you do want to make sure you're paying all your bills on time. Any late payments before or during the process could definitely hurt your chances for approval. You do want to make sure you're communicating with your loan officer about any life changes. Changes in your financial situation, your career, or your family can significantly affect your loan approval odds. Do make sure you have a paper trail for all bank transactions. If you're using money from your own bank accounts for the down payment or the closing cost, we're going to need to see the statements, and we will need to show a paper trail for where all those transactions came from. So just keep things in order and make sure you're saving those. And then do start saving money as soon as you can. It's very likely that you're going to need a significant amount of money for your loan. And while we offer many different programs to help with some of those costs, the sooner you can start saving, the better. And now some don'ts. So don't change your employer, resign, or become self-employed. Any change in your employment or your income will change the factors of the loan, and it could jeopardize your loan approval or really slow down the loan process. Don't make any major purchases. Any new debt that results in a monthly payment is going to change your debt to income ratios, and that could affect how much you could afford for your mortgage payment. So if you're already in the process, you really don't want to make any large purchases. And don't deposit large cash transactions. So we get this a lot. People save money at home and then deposit, $5,000 in the account. The problem with that is cash is hard to trace. And like I said before, we have to have a paper trail for any transaction in your account, especially large deposits. And then don't run up any balances on your existing credit cards. So I know those are not considered new debt, but your payment is going to increase if you increase the balances. So that will also affect your debt to income ratio, possibly affecting how much you can afford each month for the payment. And then one last do and don't. So do check out our exclusive first-time homebuyer program. Financial Plus is really excited to be able to offer a $1,500 discount to our first-time homebuyers. In order to qualify for this program, you just have to be a first-time home buyer, and you will also be required to set up a checking account with us, a debit card, and direct deposit. We will also ask that you set up your mortgage payment for auto pay at the end. And then don't miss this fantastic offer. If you haven't already, get that checking account opened and apply for us so we can get you that $1,500 off.
All right, so we've spent a lot of time talking about buying a home, right? The process of purchasing your first home. Just a reminder, if you guys have any questions about that process, about purchasing a home, please make sure that you're dropping those in chat. We'll spend a little bit of time at the end going through some of those questions. So we want to make sure that we're addressing any questions that you might have. We're going to shift gears just a little bit here for the last just few minutes that we have. And we're going to talk about what your options are if you already own a home. So maybe you're on this call, you're not looking to buy a home, but you want to know what you can do with your home. So there's a couple different options here, and we'll go into detail on refinances, home equity loans, and a home equity line of credit. So the first option here would be refinancing. There's a couple reasons to refinance, and basically that's just what a refinance is when you're paying off the existing loan that you have, maybe with a different lender or even the same one, and then you're getting a new loan against the home. You may do that. Probably the biggest reason is to lower your mortgage interest rate. We saw a lot of people do that during COVID. Maybe some of you on here have already taken advantage and you've got that 2%, 3% interest rate. That helps lower your monthly payment and saves you money over time. You may want to refinance to change your loan term. Maybe you want to go from a 20-year loan term down to a 10, or you want to increase the loan term back up to a longer term, 20 or 30 years, in order to help stretch out the payment and lower that monthly obligation for you. You may want to access your home's equity, which you can do with a cash out refinance on your home. Or maybe you're looking to switch products from FHA to conventional, vice versa. Or finally, you want to look to eliminate private mortgage insurance because you've gotten to a place where you are under that threshold of the 78%.
So, like Derek said, one of the biggest reasons most people want to refinance is to lower their interest rate. On this page, we wanted to show you what a 30-year mortgage would look like at two different rates. So on the left side, we used our example from earlier, the $150,000 loan at 6.375 for 30 years. Again, the monthly principal and interest payment for this would be $935 a month. And you would expect to pay about $186,890 in total interest. And then over here on the right side is the same loan amount and the same 30-year term, but it's at a lower interest rate of 4.5%. In this case, the principal and interest payment would be about $760, and you would be paying about $123,610 in total interest. So not only would you be saving about $175 a month, but that's a total savings of $63,280 over 30 years, minus the costs that it will take to refinance the loan. I don't know about you, but I do think I could find some things to do with that much money. And Derek also touched on this earlier, but if you already own your home and you have built up some equity in it, you may also want to consider our home equity loans. A home equity loan is a great option if you're considering doing home improvements or consolidating debt. And then it can also help with those large unexpected expenses that you come across. These are good because they are generally a lower rate than a personal loan. We currently offer two types of home equity loans. Our first option is going to be a home equity installment loan. This is a fixed rate loan that we offer for 10 or 15-year term. You receive all the money in one lump sum deposited to your account. And then with this loan, you can borrow up to 95% of your home's equity. And then we also offer a home equity line of credit. This is commonly called a HELOC. A HELOC is going to have a revolving line of credit and a variable rate. So it works much like a credit card does. You get a set credit limit and then you use that limit over and over. You withdraw it and deposit it to your account. And then as you make payments, the money becomes available again. Our HELOCs have a 10-year draw period and a 10-year repayment period. This means that after 10 years, your loan is closed, but you have an additional 10 years to pay back any balances that are remaining. With this one, you can borrow up to 90% of your home's equity. So I mentioned a lot of people use this loan, both these loans for consolidating debt. And I just had the pleasure of helping an older couple who are retired for a few years. They found themselves with a lot of credit card debt, as many people do. And then being on a fixed income was a big adjustment for them. So they were struggling paying month to month. We took a look at their situation and we were able to get them a loan for $47,000, and this saved them about $1,200 a month in payments. This was huge for them. They no longer had to worry about making those payments each month, and they had a little bit left over to enjoy the good things in life that they had been skipping out on. So, if you find yourself in any of these situations, just let us know. We will take a look at everything and see what we can do for you.
Awesome. No, that was great to hear there, Rose. All right, so we've got through pretty much everything. So final question is, why is Financial Plus the best choice for your mortgage? When it comes to buying a home, refinancing, or taking advantage of a home equity loan, we want to be the lender that you choose. We believe that we can come alongside you and help make that dream come true. Here at Financial Plus, we pride ourselves in exceeding member expectations. We prioritize our members and we look to build long-term relationships, right? We're not just in this just for the process of the home and getting you to closing, but we want to extend that relationship beyond that into the life of your loan. We also know that one size does not fit all when it comes to buying a house. Every single one of you guys have your own wants, your needs, your own unique situations. And so we're going to tailor our loan experience to your needs to ensure that you have the absolute best experience that you possibly can with this. We have an experienced team who has extensive experience and expertise when it comes to this. And we also have everything in-house, from starting the process with the loan officer through loan processing, our underwriter, our closing team, even our servicing team is in-house and able to help you out, making sure that everything is convenient and within reach for you. We offer competitive rates and costs, and we retain the servicing of our loans. This is an important feature that a lot of people don't often think about, but you're not just doing a loan for the 30 days from start to finish, but you're then locked into a relationship for the next 5, 10, 15, potentially 30 years of your loan's life. And so you want to be with someone who's going to continue servicing that loan. Some mortgage companies may sell the servicing, and so you're constantly chasing down or hunting who you're making payments to, how to get a hold of them. It's going to be frustrating and time consuming. We keep all the rights to our servicing here within the credit union. So if you have a question, you can stop in, give us a call. Everything is local and we can make sure that you're taken care of quickly. So yeah, we're very excited. We really appreciate, on behalf of Rose and I, we really appreciate all of you that sat through this and participated. We hope that we're able to provide a lot of value to you. And we're going to finish with going over maybe some questions that were taken. So Marcy, I'm going to turn it back over to you.
Hi, everybody. I hope you enjoyed the webinar so far. Before we respond to questions from the chat, I wanted to share a little bit of my experience. The most common question that I have been asked over the years is, when should I get pre-approved? And my response has always been the same. The best time to get pre-approved is right now, today. Whether you plan to purchase a home in 3 months, 6 months, or a year from now, it can give you a strategic advantage. It is important to know in advance if you need to work on saving additional money for a down payment or the closing costs, if you need to establish more credit, or even if you need to repair credit to improve your credit score. Whatever the case may be, it will give you a head start in this competitive market. And the only way to know if you are ready and will qualify is to apply. As we mentioned earlier, there are 3 ways to apply: online, over the phone, and in any branch. Now let's review a couple of the questions that we have. Okay, Rose, are inspections and appraisals different?
Yes, they are different. So with the inspection, like Derek mentioned, it is optional. It's something you're going to pay for outside of the loan. An inspector comes in and they just do an examination of all the components and systems of the home, like your electrical, your plumbing, your foundation, and your roof. They're just checking to make sure everything is in good working order and that there is no problems with the structural integrity. And then with an appraiser, this is an actual estimate of the home's value. So they do a interior and exterior examination, and they use that based in some information on comparable homes in the area. They use that to determine a value for the home to make sure you're not paying more for the house than you should be.
Great, thank you, Rose. Derek, I just had a question come in the chat. Which parts of Michigan allow us to repeat the MSHDA loan?
Yeah, so as far as the MSHDA, they're going to have 2 different areas, a targeted area and a non-targeted area. Depending on where you're looking to purchase is going to vary. Sometimes MSHDA will require that you're a first-time home buyer or you haven't owned a home in the last 3 years. And then if it's a targeted area, it won't matter if you're not a first-time home buyer. You can be a repeat buyer or haven't owned a home in the last 3 years can still potentially qualify for MISHDA. It's going to go by zip code. So once you find the property that you're looking for, or if maybe you have something in mind, Theo, you can let us know. We can look that up and see if it will qualify for a targeted or non-targeted. And then from there, we can let you know about the income that's required, credit score, and all of that.
Thank you, Derek. Rose, I got another question for you. How long is the mortgage process?
So the length of the process really is based on a number of factors. It's going to include, how long the appraisal work takes, the title work, and then how long it takes you to provide your information to us. But generally speaking, once you've found a house and you've made an offer on it, the mortgage process is about 30 to 45 days.
Great, thank you. Derek, I got one more question for you. Can I use alimony and child support to qualify?
Yeah, great question. So as long as we can prove that that income will continue for at least 3 years from the date of the application, that is income that you're able to utilize. So we're going to ask you for some additional documentation and able to prove those things. That might be, the divorce decree, separation agreement, legal documents from the court, child support order, that sort of thing. And we also want to be able to see that you've received that for the most recent 6 months, and we'll look to prove that as well with bank statements for the receipt of income. So yeah, great question.
Wonderful. All right, thank you. Does anybody have any other questions they want to put in the chat here? I know we still got a little bit of time. Let's see here. Okay, I do have a question. Can the closing fees fluctuate, Rose?
Yes, I mean, the closing fees are going to be a little bit different for each borrower, for each loan type. There are some fees that are set in stone depending on your lender, but some of them are going to fluctuate. So there's no real good way to know how much those are going to be until you get a loan estimate. And that would be after you found a property.
Okay, perfect. Okay, let's see. Anybody else? If you got any questions to drop in the chat. I want to say a special thanks to Derek and Rose for sharing their insight and expertise while we wait and see if we get any other questions. Really
Marcy,
appreciate
you got one
everybody.
from Madison, maybe.
Oh, let me see here. Did I miss it? Hold on. Okay,
Here, I can read it for you, Marcy, if you'd like me to. I see it.
perfect.
So Madison asks, Marcy said it's a good idea to get pre-qualified even a year before purchasing a home. Could that hurt your credit? I can answer this, Marcy, and if you have anything extra to add, but that's a good question, Madison. When you get pre-qualified, so we are going to do a hard pull on your credit, which can typically bump it down a little bit. I mean, but you're talking maybe 3 to 6 points. So it's nothing that's going to be like super long standing that's going to really damage your credit in that sense. And I think probably what Marcy's point or what she's thinking is that even that little bit of a hit that you might take if it's a year out is going to be worth it for us to be able to see potential shortcomings that you might have for that mortgage, to game plan to make sure that you're ready. We'd hate for you to miss out on pulling your credit, just for the 6 points or 3 points that it might take it down. And then a year later, when you're ready to purchase, we find out there are some things that are going to disqualify you or delay your chance of getting a mortgage that we could have taken care of had we pulled it. So while you definitely want to be careful, and it's a good idea to not pull it very often, pulling it one time, maybe a year before you're actually looking to purchase, could actually be a really strategic idea so that we can game plan and make sure you have the best possible chance to qualify when you're ready.
Thank you, Derek. We do have one question regarding construction loan information. Currently at this time, we are working on a construction loan program. So we don't have that currently at this moment, but we should have it by the end of the year. So that's one of the items we're working on, but there are additional ways that we may be able to look at doing something with construction, possibly if your current home that you're residing in has equity. So there are options. So really it would depend on each individual person's scenario. So, feel free to reach out and we can provide more information on that. And I don't believe I have any other questions to Derek or Rose. Do you see if I missed anything?
If you got them.
Okay. Wonderful. Well, thank you everyone for attending our webinar. A survey will be sent out to you, so we really appreciate your feedback. So please let us know how we did. If there's any additional information you would like to have us include in the future. And if you are interested in getting started on the home buying process or would like more information, please contact Derek or Rose. If there were any other additional questions, which I will share the questions we have and we'll forward an email with a question and answer to everybody who attended. And I also wanted to mention that after the webinar, we will be doing our drawing for our winner for the gift card, and we will be contacting you by phone. So just wanted to let you know that. But thank you, everybody. Have a lovely evening.
Thank you so much.
Thanks, Marcy.